Hello out there, traders. This is Coach G, that's Gino P with TackleTrading.com, bringing you a market recap for this good day, February 11th, 2016. I'm going to jump into Tackle Trading website, hit read more on today's market recap, and there we are. Today was a down day. Still got a bearish market. Real quickly, let's go through this. The Dow was down over 1.6%. NASDAQ was the best of the markets, but it was still down 0.39%. And the S&P right between them at 1.23%, 1.25% down. Not a real good day for the markets. Still bearish. Look at this though, 10-year bond up 20, 30 seconds. What does that mean? The bonds, people are buying the bonds and getting out of the market. Look at the yield on a 10-year bond, 1.64. Real quickly, if you double that, you're looking at 3.28. And when you start finding yields on stocks above 3.8 or 3.5 there, you're going to start seeing people jumping out of bonds and into those high yield bearing stocks. Guess who those are? That would be utilities. Utilities are definitely paying over 3.5%. And that is why you see the utility sector outperforming right now. A flight to safety, not only from stocks crashing and going down, but great yields. And we'll get into that in a second. Advanced decliners, almost 5-1 to the decliners winning, and about 2.5-1 on the NASDAQ. Volume has been better than average the last couple of weeks, with the New York Stock Exchange averaging $1 billion. We did $1.3 billion today. In the news, highlights: negative sentiment, risk aversion, financials underperform, and sharp losses in Boeing, and volatility in oil still. Headlines suggest OPEC might be willing to cooperate on a production cut agreement. OPEC cooperating? I don't think so. We'll see. Fed Chairwoman Yellen didn't provide any reprieve from the selling pressure during her testimony this week. But check this out. She did acknowledge that negative interest rates are still on the table as a potential tool for further policy accommodation. They're actually considering negative interest rates. Now remember, on December 16th, they raised interest rates. So that brings me down here to the Rate Watch calculator. There's a link we have down here under Fed Watch. If you click this, this will open up a page. Guess what the chances of a rate hike are in the future? In March, 0%. In April, 0%. June, 0%. Basically, when you get all the way down here to December, maybe 5%. In February of next year, maybe 5%. So as of now, guys, I will keep my adjustable loan. I don't see interest rates going up because they dramatically dropped based on the global weakness. And believe it or not, the Feds are finally realizing that. I think they're behind the 8 ball on that. What's strong today? Well, not strong. Nothing's really strong. But what stood out with strength? What were the outperformers? We had some telecom. That's mostly utility. Some consumer discretionary. Technology was outperformers, but they're still, most of them were down. Energy, this is just a dead cat bounce here. And staples, again, flight to safety. Weak today, financials, healthcare, industrials, materials, and the major utilities. For more in-depth news, you can click here. This will bring up a page on where we derive our information, thanks to briefing.com. And after hours, we had Groupon up on earnings and so on and so forth. Here's your after hours earning plays. There's a link to your after hours right there. Again, thanks to briefing.com. Economic calendar, jobless claims. Again, they're between 250 to 300,000. As long as they're between 253,000 people filing for jobless claims, you're not going to see that a big factor in the economic numbers. Natural gas showing a little bit of demand, down 70 BCFs. Tomorrow, stay tuned for retail sales, Michigan sentiment, export prices. Of these, I will be looking at retail sales. Why? Because that's going to affect the consumer discretionary and the RTH, retail ETF. That hasn't been doing so well. That has not been doing so well. This is going to be a big clue on spending, personal spending. Now, looking at the S&P, click this. By the way, you can click the charts on our website or the symbols and it'll bring up a chart in another window. I put in here resistance. Look at the swing high we did at 1947. And this is a weekly chart I put up here for you guys because I wanted to show you if this 1812 breaks, we bounced off it already this week. But if it breaks from a few weeks ago, the next stop is down here at 1737. About what? 80 points, about an 80-point drop. Okay, so that's about 3.5% drop more. And then from there, we're at 1650. Take note of the circle down here. This is the relative strength. We're at 38. This has to be above 50 before I even consider the bulls taking over. But the volume isn't that strong to the downside. It looks pretty big here, but honestly, it's just starting to cross right now on the OBV. If we get a solid cross through this week, this can cause more of a bearish market than we already have. So S&P, along with all the other markets, are bearish. Another big chart I want to show you in focus is the VIX. This is the opposite pattern of the market, the S&P 500. It measures option volatility. Take note to how much it's risen off its lows from 1280 up to 30. We got above 30 today. You guys, when you start seeing 30, it doesn't hang out there very long. That's fear. That's fear. And that means option prices are expensive. Now, why do we say option prices are expensive? Because when people are afraid, they buy options to protect their downside. Anything above 25, especially when you get to 30, my rule of thumb, sell options. Do credit spreads, covered calls, naked puts, iron condors. This is when you get the most premium. Take advantage of it. If you're going to buy options, make sure you're using a spread to hedge off that expense because they're pricey. And if the volatility crashes and goes back down on the next rally or dead cat bounce, your option prices will burn you because they'll get cheaper. So it's better to look for selling option strategies. If you don't know what those are, join our pro level or take a class through Tackle Trading and we will show you how to trade. As far as the sectors, pretty easy. Everything is bearish. I'm not going to bore you with those, but I'm going to click on utilities to show you how bullish they are. They're pulling back. I have a feeling they're going to come back to about the 20-day moving average. And the staples. Staples are holding in there. They're neutral. Not as strong as they usually are in a bear market. And finally, what else is bullish? Gold and silver. We have a diagonal calendar going on gold right now. It's at max profit. It's a home run. Silver, we have a covered call that's in the money and at the money. I love ETFs like SLV for those kind of plays. And USO hitting all-time lows. That's where all the news is being driven, is oil. Look at this, guys. $8. If you haven't taken advantage of investing in oil long-term, you could do it through the USO. And I'm sure most of you guys, if you know about the USO, you're already doing it. This is a strong holding of mine. I own the shares and I sell calls at the money and out of the money. Oil is at all-time lows. I think it's at a 1998 low at $26 a barrel. The rest of the world, emerging markets, I put a chart in here to show you the performance. Check this out. Down here, this line down here is oil, leading the markets lower, showing low demand. Right above it, you have China. Look how that pattern, they dip and valley at the same time. It's almost like a puzzle piece, right? Right above that, you have the emerging markets. And then right above that, you have the S&P 500. So look at the pattern. Just since December 1st, I put my sell signal in at December 3rd. I've been bearish since December 3rd, but look at how we are following step by step. First off, oil, then China, and the European emerging markets. We're outperforming them, but we're all down. Since December 1st, our markets, the S&P is down 13%. Emerging markets, almost 15%. China, 23%. And oil, down more than 34%. See how that pattern is? Do you guys see the cross-market reference there? So keep your eye on oil in China and the futures. That'll tell you where our market's going. Until they bounce, I don't expect us to bounce. Final thoughts. The VIX holding near the highs. Use selling strategy and options. Check out XME. Oil is at a bottom, but XME hit a bottom and started rallying up. That's an ETF because of gold and silver. XME is the miners. So I like oil for covered calls. Definitely hedge them because there might be some more downside. But I definitely like bottom fishing on companies like XME. Have a great trading day tomorrow. Stay tuned for more market recaps. And check out our pro level if you haven't by using promo code THETA, THETA. For new members, you get a 15-day free trial.